Good afternoon, everybody. My name is Brian Street. I am Castle Group's Executive Vice President of Field Operations, and I will be your host and moderator today as we review the financial reporting essentials. With me today as one of our esteemed partners in this is Ken Director, and I would like to give Ken a few moments to kind of talk through his background and his role in all of this.
Well, please don't blame me for my role in the laws that have been adopted, because I had no role. My name is Ken Director. I'm the chair of the Community Association practice at the Becker and Polikoff Law Firm, where I have practiced for 39 years at this point. I represent over 300 associations personally, and the group of lawyers that I work with represent over 4,000 associations between Florida, New Jersey, and New York.
Excellent. Well, welcome, Ken. Thank you. I'm looking forward to our discussion today. Obviously, in light of some of those new laws that you just mentioned, we're going to go through, kind of the fiscal management and your responsibility as a board member or even a property manager for that matter. And then kind of dovetail that into some of the new requirements for reserve fund management. Before we get started, though, we always like to know who's on the call today. So, Marinus, can you put up our first poll question? Basically, are you part of an HOA, a condo, a co-op? And hopefully nobody doesn't know what they're part of. So yeah, it looks a little bit more condo, but HOA is catching up. So it's close to 50-50, which is what we expected. A little bit more condo though. So Ken, as we get started, one of the important questions that I always get asked from a property management side is, how often and what is the responsibility to kind of review the financial position of the association? Obviously, every year we have to approve a budget, and every year, they're going through and they're getting either monthly or quarterly financials. From a board standpoint, what is their ultimate fiscal responsibility for their association?
Well, the board has certain specific statutory and documentary responsibilities, such as timely preparing at the end of each year a financial statement, obviously adopting a budget, obviously complying with the statute with regard to the operating and reserve portions of the budget. But as far as financial oversight is concerned, and this is certainly more of a management issue than a legal issue, but any well-run business, and certainly any well-run association, starts off with a budget. And month to month, there should be income and expense reviews to make sure that you are operating as you planned to operate in terms of your budget, your budgeted expenditures, and where you are for that month and where you are year to date. Because if you know that, then if you're operating in a deficit, you can address it before it becomes an operational problem. And if you're operating at a surplus, you can also use that to offset any special assessments that may become necessary during the course of the year. So keeping your fingers on the pulse of the fiscal operation is critical to good management.
That's a great point. I mean, we a lot of our regional directors and our property managers meet on a monthly basis, either with the finance committee to review the financial package and prepare for the board meeting, or they kind of meet with the subset of the board to review exactly what those expenditures are, why, if there is an overage and why. So I guess that kind of bodes the question for our attendees today. How often are you reviewing your financials? So, Marinus, if we can put up that next poll question, really curious, are you reviewing them on a monthly basis, quarterly, semi-annually, from a board member standpoint? And looks like monthly is far exceeding everybody else, which is great. I think that is very telling, especially in this day and age where, a lot of these new laws, Ken, that you were alluding to, there's a huge financial impact, and we're going to get to the reserve funding in a little bit. But ultimately, it's important and it's imperative from a board standpoint to really understand the financial position of the association. It's the only way you can make decisions. It's similar to, how you budget for your family and your house. You have to
Well,
make sure that you understand.
one of the questions, Brian, that I would ask the attendees is, how do you review your fiscal operations? Do you have the treasurer make a report at every board meeting? Does the treasurer's report get reduced to writing? Is it attached as an appendix to the board minutes? The goal here should be disclosure. And by having the treasurer make a report at every meeting, or the manager make a report at every board meeting, at least once a month, in front of the owners and in front of the board, is the best way to do this. And then take that report and attach it to the minutes so that anybody who wants to see the minutes also sees the report.
Agreed. And we actually have a lot of our managers do, a monthly management report, and it's inclusive of, where they are financially, we always like to include, how many days of cash do you have? Because, when, the stuff hits the fan, if you will, it's a big time expense. It's not a $5 fix. It's, could be $5,000, $50,000 fix when something goes wrong. So, and I'm seeing a few people chat in the Q&A section, and they have their manager or their treasurer that does the report. We're big proponents on transparency and getting the information out to the community. There should be nothing to hide. So it's making sure that you get that information out early and often.
Well, it's interesting. One of the questions dealt with an association approaching turnover, and one of the things we advise any association at the point of turnover is get control of your physical house, which means make sure you know what's wrong, if anything, with your building and your improvements, and address it. Secondly, get control over your fiscal house, which is to get a hold of your bank accounts, get a hold of the budgets, get a hold of the accounting records, and do a complete review as to how you are performing. I'm sure it will come as no surprise to our audience that sometimes developers budget lower than what is required to properly run the association because it makes it easier to sell units.
No, absolutely. One of the questions, I mentioned a finance committee. Can you talk through maybe some of the roles that a finance committee could assist the board on, and maybe where could they be overstepping or understepping, and maybe part of their charter?
Well, we could spend a whole hour on committees. If you watch my partner's podcast, she happened to have me as a guest on her podcast on committees. That's Donna Berger's podcast called Take It to the Board. And I would invite those of you that want to know how to set up and properly document the authority of any particular committee, which is critically important, go watch the podcast. But as far as the roles of committees here, if the committee has the authority to assist the board with regard to the development of a budget, that committee is going to have to operate just like the board, which means its meetings have to be noticed and open to the members. There's no exemption if that committee has the power to help with the planning of a budget. But the finance committee should do exactly what Brian and I just discussed, which is assist in the preparation of the budget, make recommendations to the board as to the budget, and then assist the board with the monthly financial updates and reports so that the committee can keep the board members advised as to where you are year to date relative to your budget. The committee doesn't necessarily supervise construction, but if you have a major construction project for which you've borrowed money or levied a special assessment, this committee can also keep track of those expenditures and make sure that approvals for payments are properly approved by the engineer before the board issues payment. A finance committee can have a fairly broad scope of authority and obligation.
Yeah, no, definitely. And you brought up the construction side, and alluding and moving into that construction side kind of goes into our, the SERS reports and the reserve funding, because that's really going to be funding those construction projects moving on. We've seen where, it's either been an owner's rep or, a project manager working with the finance committee or working with the board that really understands the construction process through and through. They can review change orders and things that happen that are way more complicated than what we would ask of the board to really have a comprehensive understanding of. So it's important to bring, Ken, you and I talk about this all the time. It's important to bring your partners around the table when you have these types of questions, if it's legal counsel, if it's an auditor, if it is a owner's rep or an engineer, to make sure, because you can't be experts in everything. We as management, always say, let's bring our partners to the table so we can answer questions and then, make sure that we're all making the right decisions moving forward.
Brian, board members are policymakers, not experts. They're not expected to
Absolutely.
be experts. They're expected to be policymakers and make policy decisions based upon the advice of experts.
All right. So moving into that, from the reserve standpoint that occurred, last year and several years into this, can you kind of we'll give a kind of brief overview of what the CSRS requirements are for, from our condo tower, especially, and maybe the difference between CSRS and non-CSRS?
Well, CSRS has a list in the statute of like 8 components. It's the roof, it's the structural aspects of the building. It's exactly what you would expect because it's the most critical portions of the building and those that create the most risk if they are not properly maintained. The non-CSRS is, the swimming pool, the pool deck, the painting, the furniture in the office, the furniture in the lobby, the interior finishes. These are all things that are non-structural, but for which reserves are required. You have to remember, we started with a statute that said reserves are required for the following items: the roof, the exterior paving, paving, the painting, and any other component for which deferred maintenance or replacement cost will exceed $10,000. And in 2025, for most of your condos, that's a long list. The CSRS, the structural integrity reserve component requirement, was enacted in order to force associations to have reserves for the critical structural components of the building. And they are different reserves than we've ever had before, because while the owners have for decades had the right to vote to waive or reduce the funding of reserves, not the board, the owners, such a significant percentage of communities did not fully fund or did not fund at all their reserves. And then when major repairs came up, it was not about the repairs, it was about the cost. I will say this to everyone listening: maintenance decisions that are based upon cost are always bad decisions. Without exception, they are always bad decisions. Maintenance decisions are based upon need and based upon the advice of an engineer, not based upon how can we get this done in the cheapest possible manner. That's why I never let my
100%.
kids buy junk at the checkout counter at the grocery store, because it was junk.
It's exactly right. And we talk a lot about that with our managers for that exact reason. Is, the deferred maintenance was a huge issue for, many, many years, and pushing off because it all came down to the price of they didn't want to spend. Some of our boards didn't want to spend the money, and they just allowed that maintenance item to prolong, which in turn got worse, and worse.
Yep.
And so then it exacerbated the cost of the fix. Could have been a couple $1,000 fix, and now it's tens of thousands of dollars for that fix, which is unfortunate because that impacts every resident. Some of our boards, maybe of our older buildings that have deferred maintenance, haven't collected anything in reserves. So now it becomes a special assessment. I mean, we're going to have to figure out ways, and I know some legal requirements to procure the funds in order to satisfy the CSRS requirements now.
Well, knowledge, I'm a big believer that knowledge is power. Knowledge on the part of the board and management, knowing what's going on with the physical structure, what's going on with the fiscal operation, is power. And frankly, the more you share that knowledge, the more you share those facts with the owners, the less blowback you will get. I have never understood why boards look to edit the reserve schedule. That's a required part of the budget. For 20 plus years now, every board in a condominium has been required to adopt a budget with a reserve schedule attached. And frankly, I recommend it for HOAs as well, because it gives the owners a glimpse into what expenses are coming up, how much they're going to be, what they are for, and when they are likely to hit. And that makes it hard for an owner to say you're not being transparent. It makes it hard for
Mhm.
an owner to say, I didn't know this expense was coming. I didn't have a chance to plan for it. And it also makes it hard for the board to say we didn't know it was coming and we didn't have a chance to plan for it. The whole purpose for a reserve schedule, some people may say, if we have the right to vote to waive the funding of reserves, why do we need a reserve schedule at all? And that's a one-word answer: disclosure,
Mhm.
so that you know what you're waiving, so that you know what expenses to be prepared for if you're not going to fund these reserves. Even now with the non-SERS components, because with the SERS you have to fund it. But with
Right.
something like the pool deck, you want to know when it's coming. Even if you vote not to fund a reserve for it, it leaves you with really no excuse when you complain about the assessment that's going to hit, because you waived the funding for that reserve component for all these years.
We have the conversation when we're doing budgets, and the residents will ask the question of when the pool deck project is coming, or why didn't they know? And as we lead into those discussions, we have to remind the residents that a building is very similar to a car. And you and I've discussed this, Ken, it's a living, breathing item similar to a car. We have to, you have to save money because you're going to have to change the tires. You're going to have to change the oil. You're going to have to add new wiper fluid, change the wipers. All these things to keep your car running effectively, you have to do for a building as well. And certain components of the building have a useful life. And that's where the reserve requirements are coming from. And, what is acceptable for that useful life, from the pool deck, it could be, anywhere between 15 and 20 years, depending. The waterproofing could be, 5 years. So there's all the different tools that, the reserve companies or the engineers have at their disposal to provide that information. You said it,
Simply
Ken,
put,
knowledge is power.
simply put, Brian, nothing lasts forever. Not your
Exactly.
building, not your car, not your cell phone, not your computer, not the jacket you're wearing, not your shirt. Nothing lasts forever. There are certain expenses that recur every year, and that's what you budget for in your operating budget. But there are also expenses that occur every several years, or maybe every dozen or 20 years. But you
Mhm.
have to be aware of them and you have to plan for them.
Yeah, I mean, we're speaking of reserves, there's a large HOA here that we're actually now looking at the entire paving project. It's a multi-million-dollar project. And the good news is for the last 20 years, they've been saving up. So they save a little bit every year for 20 plus years, earning a little bit of interest, and it continues to grow. Otherwise, if they weren't doing that, you're talking, a $4 or $5 million special assessment for all the homeowners. So I want to kind of talk
It will
through.
last for 20 years, Brian, if the project is well planned and well executed. Otherwise,
Right,
you'll
exactly.
be paying for the paving again in 5 or 6 years.
Yeah, you have to do it the right way.
Yes, sir.
That's, and we say that all the time. You have to do it the right way because it will cost you double to do it the wrong way. So we talked a little bit about the SERS and how that is now a requirement for funding. Ness, can we put up the next poll question? I'm curious if our board members think that they are fully funded in their reserves right now. And yes, I mean, we didn't break down between non-SERS or SERS, but I'm curious if you think that you are fully funded. And maybe, Ken, while they do that, can you maybe define what fully funded means? Because I know that there's some confusion out in the industry. What does fully funded mean?
Fully funded means that if your roof has a 20-year remaining useful life, well, let's be more realistic, a 10-year remaining useful life, and it's going to cost $1 million to re-roof your building, and you have nothing in your roof reserve, you need to put aside 200,000. You need to put aside $100,000 a year. Fully funded means that you are funded to the point where you have set aside what you should have set aside, so that at the end of the useful life of the component, you will have enough to pay to replace it or perform whatever required deferred maintenance arises. It doesn't mean you need to have the whole $1 million for the roof while it's still got 10 years of useful life.
No, and that's what we've been letting our boards know that, but now it's the time that they are going to have to make that up. So I know some reserve companies are also saying that if they've been, say, actually putting money away and putting reserves in a non-reserve account for, say, their roof, are they allowed to move those monies over now into the SERS? So, they've been collecting money. They've been doing all the right things. They've been voting to keep collecting reserves. Now they have the reserve component. Are they able to move monies over from what they've previously collected all these years into the new SERS account?
If you have money in non-SERS reserve funding, and let's assume that it's a pooled account with the non-SERS components as well. So you've got, the roof and the structure and all the other stuff that is now in the SERS components, and you've got it combined with in a pooled account because you have been using the cash flow method. If you want to move that money into the SERS account, that requires a membership vote because you are essentially repurposing those funds. Those funds, which now can be used for any reserve expense because they're in a pre-SERS pooled account. And you want to put them in a SERS account where they are now restricted. The same would apply if you had funds in different component accounts and you wanted to put them in a SERS account that was pooled. You're still repurposing those things, so you have to take a membership vote to do it.
So
Any vote to
basically,
waive or reduce or repurpose reserves, and repurposing includes removing restrictions on their use or adding new restrictions on their use. That requires a membership vote.
So that's huge because that's going to take quite a bit of work and effort from a board and the management company to get the residents to vote and to really understand what that means and what they're voting on. Because again, a lot of the residents that basically get up, go to work, come home, do their normal thing. They're not involved in the day-to-day. It's getting that information out to them so they understand what they're truly voting on.
Well, let's talk about the politics of this for a moment, though.
Sure. Always fun.
And I'm talking about the internal politics in your community. If I have a choice as an owner in my community to take funds from non-SERS reserves, which I can still vote to reduce or waive on a once-a-year basis when we adopt our budget, and put them into a SERS reserve account, which I have to fund in full every year, and that by transferring these funds, I'm reducing my burden going forward, I'm going to give that serious consideration. I realize this sounds to people like you're robbing Peter to pay Paul, but what you're also doing is making the decision as a community to reduce your assessments going forward by taking the funds that you have to put aside and reducing the funding levels by capitalizing that account with some money.
Yeah. And it's getting that information out because otherwise, if you don't, then the 4-letter word of a special assessment is going to, because at some point you have to fund that SERS requirement.
Well,
and you're gonna have to do that.
One of the things that you should all talk with your council and your manager about is how to set up a vote so that it is most likely to succeed. If you have to replace components that are 30 years old and way out of date and are otherwise obsolete and wouldn't be used today, and you want to modernize the area, you're going to give the owners a choice to make an alteration or not make an alteration. But you need to tell the owners, if you don't vote for the alteration, we're going to spend this amount of money anyway, just to replace what is there with something that looks as old and tired as what's there, or we could spend roughly the same amount of money and make it look like Taj Mahal. There are ways to set up these votes by providing the owners with information that can get you to the result that you want. And there's nothing disingenuous about what I'm suggesting. Actually, what I'm suggesting is being more transparent and informative with your owners, because too many people think that when they vote against a project, they are for all practical purposes voting against spending the money. If you disabuse them of the notion that if they vote no, there's no money being spent, you can more easily get them to vote for doing something that makes sense to improve the property for the same amount of money. So there's a way to structure these votes, and it's worth discussing and approaching with some degree of care.
Agreed. It goes back to what we talked about earlier. You bring your partners around the table. So bring in council, management, the engineer or whatever, because ultimately it's, you mentioned, the roof replacement. You're going to have to bring in an engineer. You're going to have to know what's happening. It's either, do you make a fix or do you do a full roof replacement? because either way, you're going to have to spend some money in order to solve the issue, especially with some of the deferred maintenance. We talked about some options here. So if say they're short, they haven't been properly saving, they now have the requirement for the SERVs.
Yeah.
How do they fund to get there? Is there a certain project comes up, we'll go with the roof. There's some options. They can borrow money, they do a special assessment. How other ways are there to fund those requirements?
Well, for example, as with any reserve, the starting point is that it is part of the budget, and the board adopts a budget to fund all reserves, SERS and non-SERS reserves, through the budget. Up until now, I guess, this last budget, any budget adopted before 12/31/24, the members had the right to waive or reduce the funding of that part of the budget, not budgeting for the reserves. That's required, but you could waive including that part of the budget in the assessments that are levied against the owners. You no longer have that option for any budgets adopted from this point forward. What you can do to fund these, aside from funding them through the budget, and these are new concepts, and I'm not sure any of them have really been addressed by a court or by the regulatory agency in Tallahassee. Some people want, as we've already discussed, Brian, to divert existing non-SERS reserves into the SERS account so that you have a starting point other than zero, so that the future funding is reduced proportionately. Some want to set up a line of credit to fund the SERS reserve, and I think there's some legislation already being talked about in that regard. But the problem with using a line of credit is, as is with most loans, you got to pay it back.
Right.
So you're going to be funding the reserve one way or the other. And if you use a line of credit, you're going to be funding the reserve plus paying interest on what you're putting in the reserve account. So you need to be smart from a fiscal standpoint and make sure that you're not creating a larger expense to fund these accounts by trying to fund them through other means. One of the other ways that reserve accounts are funded, including SERS, is by levying a special assessment to, again, capitalize the account so you start at a point above zero so that your annual funding obligation is proportionately reduced.
Mm-hmm.
But with the SERS reserves, regardless of what other things you try to do, the SERS reserves have to be funded in full every year. The legislature made an exception for using a line of credit to defer reserve funding into SERS reserves, but that exception applies to exactly one condo in the whole state. Somebody, I guess, had a good lobbyist, or their rep for their district took it on for them. The legislature may consider other ways to defray SERS reserve funding by setting up a line of credit or using other facilities so that you don't have to take the full financial hit. But as of right now, SERS reserves are going to have to be budgeted for and funded in full every year. And the budgeting for those reserves is based upon a structural integrity reserve study. It's not based upon estimates from the board or from a finance committee. It is a breach of fiduciary duty under the statute not to get a properly done reserve study.
Right, which now also has to be posted to the website and made available to all
and distributed to all
residents.
owners.
Yep, exactly. So it's very important. I from a management standpoint, previously we may not have had as much teeth in this process because the board and the residents could vote it down, vote against it. I think this allows us, because it is the right fiscally responsible duty for the building and for the HOA to save money for that kind of rainy day event. So it really kind of gave us a little bit more teeth.
And frankly, Brian, if I'm a board member listening to this, I would rather take the heat from the members for making a full and transparent disclosure of the expenses that are coming up than not make those disclosures and then try to explain to them why they're being specially assessed.
Exactly. Some of the questions that have been popping up through the Q&A as well have to do with audits. And now that obviously from a financial reporting standpoint, you're going to have the reserves, you're going to have the non-reserves on the financial statements. But some of the questions are, how about the audit? I know there's some new legislation as well around the ability to waive audits. And how often should an audit be performed and at what level? Can you maybe drill in a little bit more to the responsibility of the association in receiving an audit?
If you have revenues of over $500,000, you are required to do an audit. If you have revenues between 300,000 and 500,000, you are required to do a review. And if you have revenues between 150 and 300,000, you are required to do a compilation. If you are under $150,000 in revenues, you do a statement of income and expenses. The members can vote each year, but the vote has to occur during the fiscal year to which the vote will apply. So if you're on a calendar year fiscal year, it is now too late to vote to reduce the financial reporting requirements for fiscal year 2024. That vote had to take place in 2024. So you can vote to reduce an audit to a review, a compilation, or a statement of income and expenses. You can vote to reduce a review to a compilation or a statement of income and expenses. You can vote, what I'm saying is you can vote to reduce the financial reporting requirement, but you can only do it 1 year at a time, and you cannot do it in consecutive years.
So if you waive in let's say you did everything right in 2024, you waived the requirement and you waive it again, you cannot waive it again in 2025. You can't have back-to-back years.
That would be correct. I have advocated to clients for many years, especially if you have a calendar year, fiscal year, that you adopt your budget, usually sometime October, November, December. But on the same day that you adopt your budget, you conduct your vote on financial reporting and you conduct your vote on reserve funding. So that is your fiscal planning day for the following year. And that way you've got your budget adopted before the fiscal year starts. You've got your vote on financial reporting within the statutorily required time frame. And you have voted on how much you're going to fund for the non-SERS reserves before the beginning of the fiscal year, which only makes sense. Otherwise, if you haven't taken the vote by January 1, how does the board know how much to include in the first quarter or first month assessment?
No, absolutely.
I like the idea of having a financial planning day where you have the board meeting to adopt the budget and the membership votes on financial reporting and reserve funding.
Agreed. We try to do that, very early on in the year, basically September, October timeframe. From a budgetary standpoint, most associations, it's that, traditional 80-20 rule. 80% of the budget is contractual items. And then 20% is that discretionary, projects come up. So ultimately, you should be able to craft your next year's budget, in a fairly easly time frame based on, say you took the June financials and you get there. Actually, this goes into another question. You and I were talking about this a couple of weeks ago, the independence between who's preparing your financial reporting, the CPA, and how that all plays in. Can you talk a little bit about that independence and the requirement for independence?
It's axiomatic. You're going to have an independent auditor prepare your financial reports. That will not be a member of your finance committee. That will not be somebody who's a retired accountant from New Jersey. No offense to accountants from New Jersey. And it will not be the same person who does your monthly income and expense statements. You need those done. Those are typically done, quite frankly, by management.
Correct.
A lot of smaller communities that don't have a management company, they may use an outside bookkeeper. But the person that does your year-end financial report should not be the same person that is preparing your monthly statements.
That's the wolf watching the hen house or whatever.
Listen, I deal with a lot of personalities, having done this for nearly 40 years now. But nothing makes me more angry than an association getting ripped off because they don't have proper protocols to ensure the integrity of their deposits and their accounts payable.
Well, agreed. Yeah, we try to put the best policies in place as well, just to try to guard against that as well. And then if an association is required to have the audit, what are there any penalties if they don't perform that in that calendar year? So they waive it in 2024. They have to do it this year in 2025. What if they don't?
The answer to your question is yes, there are penalties. The division, the Department of Business and Professional Regulation will levy fines against the association. Good luck explaining that to your members. And they will order you to do the audit after the fact anyway. It's not like by skipping it, you get out of doing it. What's going to happen is it's going to be more time consuming and more expensive because you're going to have to reassemble records from a year ago. I've seen the DBPR order communities to go back and do reports from 2, 3, 4 years ago because they didn't do them.
Wow. So again, yeah, it goes back to our construction you're going to pay twice basically for the same amount of work just by doing it right the first time.
Yeah, it's like the commercial for oil filters from the 70s with the mechanic holding an oil filter saying, you can pay me now or you can pay me later.
Very
Best to
true.
get it right the first time.
So I'm just going through a couple of the questions. And maybe just for clarity, so now we are collecting the monies. They're in the reserve accounts, either non-SERS or SERS. Are those able to be invested? We've always made the request that obviously you have to protect the principal, but there's you want to do it in the most risk-averse method and vehicle as possible. Are there any requirements on the investing of those SERS requirements or SERS
Let me give
monies?
you a technical answer and a practical answer. Technically speaking, you start with your bylaws. If your bylaws require the money to be in a bank or savings and loan, then that's where they have to be. If your bylaws allow more flexibility with regard to investment accounts, I suppose it is permitted, but I would not want to be on a board that invests the money someplace and then the market takes a dive and suddenly you have less money. And I don't know that the state would even allow it because by putting the money in an account that is subject to the ebbs and flows of the market, can you really say you're using the reserve for the purpose for which you set them aside in the first place? And I don't know if you can say that because if the market goes down and your reserve balances go down, you have just spent reserve monies on something for which they were not intended in the first place, which is not what the statute allows. So I echo your comment, Brian. If I'm on a board and we have somebody says, oh, we've got $3 million in reserves, let's put it in the market and earn 18% on it, which you could do. But what if you don't earn 18%? What if the market dips? We live in a volatile world, in case you hadn't noticed.
Very true.
We live
Yes.
in a volatile world. It is not what it was. There are wars going on at least 2 continents. And better safe than sorry with reserve monies. And all the people who will push you as board members to invest the reserve money and generate a higher return, they're typically not board members. And that means there's an important difference between you and them. They don't owe a fiduciary duty to anybody. You do.
Mm-hmm. Well, very true. And we have that conversation because again, going back to your board members that you maybe did something in a prior life. They used to be investment bankers and they know that they can get a higher rate of return. You want to be as cautious and risk averse as possible. To your point, we don't want to lose that principle. So we always, say, go the simple route, laddered CD program, some money market accounts, something that is not going to be adversely affected because Elon Musk says something and all of a sudden the stock market drops tremendously. It's important because you have to maintain it because you have to stand back to our original comments of standing in front of the membership as either the treasurer or the finance committee to explain, the income and expense and what's happened with your reserve funding.
And I'll say it again, Brian, unless and until the statute is amended, I don't know that the state regulatory agency would even sanction investing reserve funds like that. And even if they did, I don't know that I'd want to be on the board that puts the money in a bad investment.
Very true. Very true. Some of the other things, we talked about, obviously there's a lot of things happening in the world, very volatile, and inflation has been a key topic on I think around the kitchen table for most homes. A lot of the reserve reports that I've seen either have I think a smaller number for inflation or no consideration of inflation on the reserve numbers. Is there a best practice from that
Yes.
standpoint as it pertains to inflation?
Well, you're referring to inflation, which is an economic factor and a market factor, but you also have to bear in mind that there may be events that prolong the useful life of an asset or things that shorten the useful life of an asset, which is why even though the statute requires a reserve study, I think every 10 years, that doesn't mean you shouldn't update your reserve analysis by bringing back your reserve analyst every 3 to 5 years. Because what's most important with the reserve schedule attached to the budget is that it contains an accurate disclosure. And it's not going to be accurate 10 years from now. We all know that. You could
Mm-hmm.
have a windstorm that shortens the life of the roof. You could put some of that, foam on the roof that will prolong its useful life. There are things that change the useful life of the component. And yes, there are inflationary factors. I mean, look at the way prices changed during COVID for time and materials. And
Right.
look at the delays that people suffered in supply lines. So staying on top of your fiscal plan doesn't mean just doing your reserve study and then I'm good for 10 years. If you're going to do a proper job of it, you're going to have to update it every 3 to 5 years. And for those of you listening to this webinar who have at one point run their own business, you didn't wait 10 years to reevaluate your expenses and particularly your capital expenses. You probably revisited, if you ran a restaurant, your stoves, your ovens, your pots, your pans, all of your capital components. You probably were keeping track of them and keeping track of the prices in the market on at least a year, every 2, every 3 year basis, so that you could keep your restaurant running.
Oh, absolutely. And that's where I was really going with that inflation, because we're seeing, from cost of materials and everything, there's no way to really gauge it right now. I mean, we joke about the cost of and the price of eggs, but that really kind of permeates every single market. And if we have these new tariffs for steel and crude oil and all the stuff that's happening, that inflationary number, it's hard to calculate. It's hard for any reserve company or engineer to really develop a methodology of coming up with what those numbers are, just because it's so volatile and it's changing. Every time I watch the news in the morning, it changes every single morning what that is going to do for here. So I agree with you, Ken. It's you
There
have
are
to up those
there are
reports.
things happening in our country where the composition of the workforce is going to change, and therefore the wages that have to be paid to the workforce are going to change. A lot of things happening that are going to affect prices. Now, I haven't had eggs for weeks because I don't want a case of bird flu.
Or the Waffle House that's charging an extra 50-cent surcharge just to get a single egg. So it's I don't think we know what's on the horizon on some of these things, but it's again to be fiscally responsible, you as the board and your finance committee, your management company should be having these conversations and not leaving it up to chance. One of the questions that came in, and this is always fun, is obviously the SIRS report's coming back and it says maybe you have to replace, the roof next year. What if the board doesn't make the moves to do those projects? Is there any recourse that either the membership has or the DBPR, the state has, if
Yes.
a project they're not moving forward?
Well, I wanted to make a distinction between a time frame analysis from your engineer and a time frame analysis from your reserve analyst. Just because the reserve analyst says the roof has a useful life that ends in a year, that doesn't necessarily mean the roof is actually no good after a year from now.
Right.
That depends upon the actual condition of the roof, which is an engineering determination, not a reserve projection analysis. So the bottom line answer to your question is that when the roof needs to be replaced, based upon the condition of the roof and the advice of a roof consultant or an engineer, that's when you must replace the roof. Just because the reserve schedule says the roof is at the end of its useful life, that's not the end of the inquiry for the board. Does that answer your
No,
question?
It does because I mean for our condos or even any roof, I mean for an HOA clubhouse, it has that useful life, and you should be doing routine maintenance, which is part of your normal operating budget, not
Agreed.
part of the reserve. um, it could extend the useful life a little bit, and and again, the reserve companies, the engineers, they're gonna be extremely conservative in their approach. Again, not knowing exactly what's happening in the world and exactly how you are maintaining it. If a board, and you said the word must, they must replace the roof, at the end of that useful life, or it's required. What if they don't? What recourse does the membership have if they're not moving forward with those projects?
Well, the association and the members both have the right to enforce the governing documents. So if the association has the obligation to replace the roof, any member can go to the state agency and force the board, or go to a court and force the association to fulfill its maintenance and repair obligations. It's no different than if the association brings a lawsuit against an owner for a violation of the governing documents. You can get an order compelling the owner to comply. The owner can get an order compelling the association to comply.
Good. I want to go back to one of the things you said. A couple of questions I saw come through, and we talked about the movement of monies from non-SERS into the SERS accounts. We mentioned, obviously it's a membership vote. Is that based on your documents? Is it a majority of those voting? Is it a majority of those in the room? How would that be
It's a
determined?
statutory vote, Brian, and it's a majority of the entire community.
Excellent. Perfect. A lot of great questions here, everybody, and I'm not sure we're gonna be able to get through all of them, so we're gonna try to kind of go through them as quickly as possible. One of the requirements, Ken, was they actually had to have the reserves study done by the end of 2024. What happens? Go
Yeah,
ahead.
and you and I both know there are probably hundreds of associations that just weren't able to get it done because there wasn't enough supply in terms of expertise to do the reports. And I don't know, what's going to happen to the associations that didn't get it done, but I sincerely hope they are all trying to get it done. And they will get it done as soon as reasonably possible, and then they will circulate they will file it with the division, and they will circulate either the report or a notice that it's available to the owners within 45 days. There are people that couldn't get it done because it was simply an impossibility to get someone scheduled to do it. I don't necessarily want the state to bring any sort of hammer down on those people unless they're sitting on their hands and they just don't want to be bothered to do it.
Do you think there's going to be, obviously the division's doesn't have the manpower either, I don't believe, to go out and actively search every single association. So I think it's going to if it's going to be a irate resident that's going to bring up a claim, then that's going to raise it to the top of the list, as most of these boards are moving forward. I mean, we recommend go get it now. We've talked with a number of reserve companies or engineers, and yes, they're booked up. I mean, they were booked all of 2024. They're booked through Q1, even into Q2 of 2025, with all these projects to get moving. Go ahead.
It's a requirement, and the legislature felt strongly enough about the milestone inspections and the structural integrity reserve study to specifically state that if you don't comply with the statute, it's a breach of fiduciary duty, which means personal liability for the board members.
So we have a couple new board members that are on. So welcome to you all. They were asking the question, the difference between pooled and straight line reserves and the pros and cons of each. So I don't know if you want to kind of maybe touch upon quickly as we near the end of our time here, but maybe touch upon what the two differences are.
Okay, sure. When the concept of reserves started like 30 plus years ago, you would have a separate reserve for every reserve component, for the roof, the paving, the painting, the interior finishes, the structure, the doors, the windows, etc. And it was called a straight line reserve or a component reserve because money was set aside for each component and could only be used for that particular component. If you wanted to, for example, take money that was set aside for the roof reserve and use it to pay for the painting, you needed a membership vote to do that. In roughly 2003, if my memory is serving me, the legislature allowed the communities to vote what was called, pardon me, to fund what was called a cash flow reserve. And the monies, instead of going into individual component accounts, the money went into a pooled account. And that money could be used for any reserve expense, for any of the reserve categories that were included in the reserve schedule. You could not use that money for operating accounts for operating expenses without a membership vote. But the money in the pooled account, if you had 26 reserve items on your reserve schedule, the money in the pooled account could be used for any reserve expense. Typically, and I'm not a mathematician, but what I heard from reserve analysts is that the cash flow reserve, for some reason, tended to be less costly year after year than the component reserve. The cash flow reserve is designed so that the reserve analyst makes a 30-year projection of your reserve expenses, which, let's face it, is highly speculative.
Right.
But they do the best they can. And the cash flow funding model is based upon the association having enough money at any given time during that 30-year period to cover the reserve expenses that are expected to arise that year. So as you might imagine, with a cash flow reserve, the balances are up and down. With a straight line reserve, it's a little bit steadier. Some communities to this date still prefer straight line reserve because there's less risk of the bottom dropping out in terms of the reserve balance.
Right. Yeah, I mean, we've always recommended the pooled because it gives you a little bit more flexibility as well. So we go back to our roofing example. The reserve company may have said it's a $1 million project, but when you start getting quotes to do the job, it turns out to be $1.1 million. So if you are doing the straight line component method, you've saved up the million, but now you still have a short of the 100,000.
And we all know that's going to happen, but as you just said, with the straight line or component reserve, the funding model is based upon the estimated useful life of the asset and having enough money to pay to replace it or do the deferred maintenance at the end of its useful life.
Excellent. So as we're down to about our last 5 minutes here. Some of the takeaways that I have is, have the conversation early with your legal counsel, with your engineers as it pertains to the SERS and how you are going to be investing. If you need partnerships with your bank, with your auditor, sitting around the table. And the other big takeaway, and then I want you to kind of close this out here, is the overall transparency. You as the board shouldn't have anything to hide. And so it should be all out in the open from a monthly financial kind of disclosure to the membership during a board meeting, and basically nothing to hide is kind of how I want to kind of sum this all up. You should be doing everything from a fiscal responsibility for the association.
I don't know that I have much to add to that, Brian, because the theme I keep returning to in this presentation is keep your eyes on your fiscal house, and disseminate information, because no owner is happy about getting a special assessment. They're never going to jump up and down for joy when you call a meeting to levy a special assessment. That's a given. But you never want them to point to you and say, we had no idea this was coming. You did not make the required disclosures by attaching an accurate reserve schedule to the budget every year. It's the way you run your own businesses. It's the way you should run the association as a business as well.
Excellent. Well, I guess as we come to the end of this one, I just want to say thank you. I know we weren't able to get to all of the questions. There's some great ones in there. A lot of it had to do with investing the monies. So obviously, like you said, some of our associations have very large reserve amounts, several $1 million. And there's a bunch of questions about laddered CDs, money markets, if they bought government bonds and things like that. I would say talk to legal counsel and your legal counsel to make sure that you're doing everything correctly as it pertains to protecting the asset, protecting the principal of those funds. Everybody was giving some perfect examples. And again, we want to try to maximize your return without changing and keeping it very low risk. So again, I want to thank everybody.
Keep your eyes on what the legislature does this year.
Yeah, absolutely. I'm sure we're going to have a few more of these coming up from a leadership webinar with some of those changes that are coming up. So again, I want to let you know that our next episode is going to be March 12th. So we look forward for you all to sign up for that.